Hey everyone, Chris Archer. I want to take some time and talk today about taxes. Taxes are an issue that come up in dealing with all sorts of issues related to divorce, from the sale of a residence to child custody to alimony. And so I think it's important for everyone to have at least a basic understanding of the tax implications that come along with going through a divorce. Want to preface this by saying I'm not a tax attorney, and if you have questions, serious questions about tax issues and how you may be affected by any of this, I think it's important to consult with a CPA or an independent tax advisor to get answers to those questions. But I wanted to at least give you a kind of a cursory overview so you can have a basic understanding of maybe some of the issues you should be on the lookout for. So first, let's talk about child custody and how that impacts the dependency exemptions. So under our laws, the custodial parent is going to be entitled to that dependency exemption, meaning that they're going to get to claim the children as taxes at the end of the year as dependents, and the non-custodial parent, who's generally the one paying child support, is not going to be entitled to that dependency deduction or exemption. Now, this can be reallocated between the parties by contract. So, for example, in a settlement agreement, the parties could agree that the non-custodial parent would be entitled to that deduction, and the IRS is okay with that, but it does have to be reduced to writing and submitted with your filing to the IRS. Child support. Child support is going to be non-deductible to the person who pays it, and it's not going to be considered income to the parent that receives it. It is just a non-taxable event. So the payment of child support, you cannot take a deduction for that if you're the parent paying, and if you're the parent receiving the child support, that is not going to be included in your income. That will be reported to the IRS. Alimony. There's been a big change here recently, beginning in 2019. Under the former law, alimony was deductible to the spouse paying it and was treated as income to the spouse receiving it. However, that is no longer the case. This is now treated like child support. It is not a taxable event, meaning that the person paying it is not going to get to take a deduction any longer, and the person receiving it is not going to recognize it as income. Property divisions. Generally, when going through a divorce, divisions of property and retitling of assets, those are going to be non-taxable events. And what will happen is if, let's say, a piece of property was previously titled in the name of one spouse, but as a result of the divorce order or agreement, the property is going to be transferred to the other spouse. That transfer itself is not going to be taxed. So the transferor, the one giving the property, is not going to have to recognize a gain and pay tax on that at the end of the year. And the individual receiving the property will receive it with the same tax basis that the transferor held. So, for example, when we're talking about capital gains, if you buy a piece of property for $10,000, it appreciates another $10,000 over the years, and then you sell it for $20,000. Generally, you would have a $10,000 gain that you would have to pay tax on. When the property is transferred to a spouse as a result of a divorce order, the spouse is going to inherit or take that property with the same basis, so that same initial $10,000 cost basis that the transferor had in the property. And if the new spouse or the spouse later sells it, then they would have to recognize whatever gain or loss using that basis. Quadro distributions. These are qualified domestic relations orders that you may have heard of, and these deal with pension plans and 401ks, retirement accounts. being transferred from one spouse to another, or a portion of those accounts being transferred from one spouse to another upon a divorce. And so what the Quadro does is it allows for these transfers to be non-taxable events. So we roll over from one spouse's 401k into the other spouse's 401k, and nobody has to recognize any taxable income as a result of that transaction. However, once money is dispersed, regardless of whether or not there's a Quadro in place, if one spouse then pulls that money from the 401k or from the retirement account, then that could be a taxable event. So if, for example, one spouse has $100,000 in a 401k, $50,000 of that is transferred to the other spouse via Quadro as a result of the divorce order. If that spouse then pulls that $50,000 or any portion of that money out of the 401k, that could be a taxable event and trigger tax liability to the receiving spouse. Attorney's fees. This issue is much more complicated. The IRS has said that some attorney's fees can be deductible, some cannot. So this is a particular area where you want to get advice from your tax preparer before making any decisions on this issue in particular. But generally speaking, attorney's fees for personal expenses and divorces are not going to be deductible. However, in certain situations they can be if the dispute that the attorney is representing you on involves issues of alimony or the protection of property or income or tax advice. Any of those things can trigger deductibility of attorney's fees. And so, this is one area where sometimes yes, sometimes no is the answer to the question of whether or not those fees are deductible. Just to recap, issues that we need to be thinking about as far as taxes go: child support, dependency exemptions, alimony, property divisions, sale of a residence. This is one I didn't touch on, so let me go back and touch on that. The sale of a primary residence can trigger gain and taxable income, but the first $250,000 of gain are going to be excluded for individual taxpayers, and the first $500,000 of gain are going to be excluded for married filing joint taxpayers. So this means that if you purchased your home for $100,000 and you later sell it, it would have to be sold for more than $350,000 before you would trigger any taxable gain on that transaction. So just wanted to touch on that briefly with you today. If you have any questions, let me know. Give me a call at the office. Shoot me an email. Happy to talk to you, answer any questions. If I can't help you, I'll point you in the direction of somebody can, and I'm going to go call this person back right now and then see if I can help them. Hope you have a great day. Thanks.